All right, and we should be live. Welcome to Tax Tuesday, everybody. My name is Toby Mathis,
Hi, I'm Eliot Thomas, manager of the tax advisors here at Anderson.
and we are doing our best to bring tax knowledge to the masses. Let's see. We'll wait for everybody to fill up. I have a couple minutes while everybody kind of comes into the room. It never seems like everybody comes on once, just at one time. It seems like everybody just kind of trickles in. So I'm going to watch those numbers as they go up, and then we will dive in. Let's go over the rules. You guys always love hearing about the rules, right? Number one, you can ask live questions via the Q&A feature. And if I'm going to look up, we could see them over here, but in your settings, you're going to go down below and it's going to say Q&A. That's where you leave a question that is a lengty question, where you're actually asking our professionals a question for clarity. If it's like more than a few sentences, that's where it's going to be. On the chat, you can do something like ask for clarification of like something we just said, or leave a comment, or even better yet, tell me where you're sitting right now today. And I don't mean like in your kitchen. I mean like what city or what state you're in, what country you're in, just so we get an idea. Somebody says, can you please speak on the bank runs and thoughts? I got, we'll do that. Baltimore, Wisconsin. Yeah. Colorado, Florida, Chico, California, North Hills, California, Los Angeles in the house. We got a lot of, there goes Seattle, there goes Washington, D.C., Miami, Florida, a couple of Miamis, Loganville, Fort Worth. Oh, wow. Vegas. Hey, you're right here with us. Austin, Missouri, Clinton, Maryland, Reno, Oklahoma City. Do I have to mute myself? No, you don't have to mute yourself. Don't worry. Hawaii, hospital outside of San Francisco. Fort Lauderdale, hopefully you're working and not in the hospital. New York City, we got people, you got them from all over the place. They're coming, pouring through. So, and they're even going into the Q&A too. So anyway, hey, we're here to answer your questions. We got a whole bunch of set questions that you guys email in. Speaking of emailing in, you can always email in questions at taxtuesday@andersonadvisors.com. And we get them throughout the weeks when we're not broadcasting, and then we put them up. So you'll see some here. If you need detailed responses to your specific question, you need to be a client. So like if you're getting into advising and not just asking a question about a tax rule, then you're going to need to be platinum or a tax client, which if you want to know how to do either of those things, just say, hey, I'm interested in learning how to become a client, or I want to be platinum. Platinum's $35 a month. It's not a break the bank, and you can ask tax questions in writing. And then this is supposed to be fast, fun, and educational.
We try to make it that way.
Do you have fun doing these?
It's fun and educational. About the fast part. Right?
Now, what about somebody says, hey, I want to hear about the let's see something. Oh my God, I got my first aristocrat today. Thank you, Marquet. So that's an aristocrat, a dividend aristocrat. There's dividend kings and aristocrats. So sounds like you bought yourself a really good $1 billion plus company that has been increasing its dividends for at least 25 years. Yes, they're out there. And that's awesome. Keep doing it. Even in this market, you never stop buying. I have a little chart that says when to be buying in the market. Buy. You just don't go crazy at any time. You're not timing the market. You're just consistently investing. And study after study after study has shown that is the best way to be investing, not trying to time things. Speaking of timing things, this whole bank run, it's not the end of the world. It just seems like it sometimes. If your money's in a bank that gets tied up in one of these receiverships, anything over $250,000 is exposed to loss. But you've seen Biden and the administration coming in and saying, hey, we're not going to allow those losses to occur. We're going to find strategies to allow the banks to continue to operate. And what's really happened, in my opinion, is you had banks that they're limited in what they can invest in, and they're investing in bonds. And these bonds are like, let's just say it was a mortgage-backed bond. It was basically mortgage-backed securities. And we were getting loans on mortgages, 3%? Mm-hmm. So the coupon rate might be 2%. So you invest in one of these things and you're getting paid in years coming forth at 2%. And who wants that right now? You can go get a CD for 4.5%. So there's no market for the bonds. So the bond market just got crushed. Well, you still have a guaranteed return of 2%. The bank's still going to have its money, but it doesn't have any market for it. So in my personal view, it's like if I was the feds, I would be saying, hey, let's do a buyback on those. Maybe you don't even pay the interest, man, and it works that way. But, personally, I just look at the Fed raising interest rates the way they have, is they knew they were going to keep raising interest rates until something broke, and we just heard a snap, right? So hopefully we're through some of this. Some of you guys went through it in 2008. We had folks here, I think it was Silver State, was that the one that went under here locally? Yeah, there was businesses, because everybody thinks it's always rich people that have the bigger accounts. They had their payroll in there, about 3 million. They went in and talked to the bank, and they said, we're worried about your liquidity. We've read some stuff, and the bank assured them everything's copacetic. Don't worry, we're fine. And then the Feds came in and shut them down, and they lost their $3 million. You end up dealing with the FDIC trying to get the $250,000 back. That's a process in and of itself. So, the best advice to you guys is spread your risk out amongst multiple institutions if you have large balances. If you're below 250, you really don't have too much to worry about. But you're going to see is everybody's going to run to Chase and Bank of America and Wells Fargo. Who's another big one?
U.S. Bank.
JP Morgan Chase. Well, I said Chase.
This was number 16, I think, ranked bank.
They're
up there.
They were large, but
hit the VC, the venture capitalists, really hard.
Well, they're going to get bailed out, so apparently they're going to be okay, right?
Yep.
And then you had Signature topple over too. So we might not be done with it, but if you remember 2008, 9, 10, when these banks were closing, it does cause an issue. The issue, in my opinion, is because the Fed just started raising interest rates and devalued all the bonds. I don't remember a single time if you're a nerd, correct me if I'm wrong, but I don't think there's ever been a year where we saw the stock market and the bond market decline. I don't remember a time in anything that I've seen where you saw 20% plus losses in the market, plus you saw bonds just get crushed too. But anyway, that's not why you guys are here. You guys are here about taxes. You can ladder your CDs if you're sitting on a few $1,000,000 and you're just so worried. What you do is you buy CDs with a bunch of different banks. They're all insured, and that way you don't have to worry. Or you go to like a Schwab where they have extra insurance. I think it's like up to $150 million. It's a huge amount. But anyway, let's go to these. What is an installment sale on real estate? How do you utilize it within the tax code? So that's question number one. We'll get to it and we will answer it. What happens to accumulated depreciation on rental property when the owner passes away? Does the person inheriting the property need to account for depreciation recapture from the deceased owner when you later decide to sell that property? This is a long one.
It is.
If the person inheriting the property gets a step up in basis, does that new basis now become the basis to calculate depreciation? And if you keep the property, so we'll get into all this. Can the person inheriting the rental property also have a new cost segregation done? And would that be affected by any cost segregation done previously? Any other tax considerations to be aware of when inheriting rental property? So that is about the most comprehensive question I've ever seen on inherited property. So we'll get to that.
I picked it.
Yeah. We get hundreds. So when I used to just grab 10. I'd be like, here, just grab a row. But it's always fun. You grabbed a long one. I received a 1099 INT from a bankrupt crypto company I invested with called Celsius. So this is, again, kind of relevant to some of the stuff that's going on. The money on the 1099 never touched my bank account, as it is currently locked in a crypto wallet on their website for the last 8 months. It was interest from USDC coins I staked, but I left it all in the wallet to reinvest. Am I supposed to pay taxes on this money that I never received, or can I leave it be and ignore it until the bankruptcy is resolved? Good question and tough answer.
Very timely.
How does the law or the tax law treat the hiring of children by an LLC? At what age can they be hired? Which circulars discuss this? I am using home office and depreciating part of the house. How will it look on the taxes at the year I sell it? Good questions. Are there any tax deductions for real estate held in a self-directed IRA? So when you see SDIRA, that just stands for self-directed IRA. Can you explain S-corp taxes with shared distribution? When it's time to file taxes, do we pay taxes all shared distributions? So I'm not quite following that, but I think we'll break it down. I think I see what they say. Do you have to pay taxes on everything you receive, or just like the profits, et cetera? So we'll get into that. I started an LLC C Corp with Anderson Advisors in October 22 for real estate. I have paid $20,000 plus in networks, education, probably getting training. I did not do any deals in 2022 for my new real estate business. Can I still write all that off for the business? I have used my personal credit card to make purchases for the new REI business, real estate business. Since I do not have a business credit card, did I break the corporate veil? ? So we'll have some comments on this for sure, but we'll get to that. What org structure for small business is audited the least and provides the lowest tax liability? There's stats on this one, guys. How do I best utilize my C Corp status for tax savings and investing in real estate? We have my 1099 paycheck going to our C Corp bank account and then pay out about half of it to our personal bank account as a paycheck. But how do I utilize the other half that's sitting in the C Corp account, such as to buy a new short-term rental or a long-term rental investment property? So we'll dive into all those. If you guys are seeing that there's a wide variety of questions, you're probably already thinking to yourself, hey, I have some answers to that. Well, fantastic. If you like this sort of stuff, go to my YouTube channel. You can subscribe for free, put notifications on by clicking on that bell, because then you know when a new video comes out. And more importantly, if you like Tax Tuesdays, that's where we put the recordings. So you just pop in there. If you want to know how to get to the YouTube, just go to aba.link/YouTube. I'll even make the little, it doesn't flash anymore. I used to have the thing flash, but the animation is not working, Miss Puri. I'm going to give Patty the look. I like my little flashing red thing. Just teasing.
Okay.
All right. Eliot, what is an installment sale in real estate? How do you utilize it within the tax code?
So an installment sale simply means that you're getting payment over more than 1 year. It could be for 2 years, could be for 20. So you're just getting chunks of money, typically the same amount each year, or a prorated amount for the first year, perhaps a down payment first year, but further payments are generally the same amount, doesn't have to be. When we talk specifically for real estate, I thought this was kind of interesting because we have to watch out for that. If you're just buying an investment property, well, then you can, the recipient only has to pay tax on a certain portion of what they receive each year. So in other words, you don't have to pay all the tax up front. So if you sell at a profit of maybe $2 million, doesn't mean you have to pay all that profit right away, because you just do it as your chunks of payment come in. And that's based by what we call the gross percentage. And we just take that times the amount of payment. There's going to be a gain component, there's going to be an interest component, and then there's going to be the principal itself. So you'd record each of that each year on your sale of real estate.
Yeah. So it's, if you're a code fanatic, it's 26 USC 453. And when you do an installment sale, which means you're taking the payment over a longer period of time than just in 1 year. So it could be 2 years, it could be 20 years. You're spreading the tax obligations out over that period of time, unless you opt out.
That's right. You don't have to.
Yeah. So like if you're selling your rental, your personal residence on a installment note. So like, hey, I have, $300,000 a gain. I'm married. I don't have to pay tax on it. You may say, I'm going to opt out of the installment sale, even though you're carrying back a note. So it's basically like having a mortgage on the property and you're the bank and they're paying you over time. You're going to get gain back. You're going to get return of basis, which is zero. You're going to get depreciation recapture, and you're going to get interest. And guys like Eliot break it all out and figure out what it's gonna look like.
One thing I just want to also add is that don't mix up this kind of sale of real estate with flipping, because now we have a whole different tax code provision for that, and flipping is considered inventory, and you cannot use an installment sale with inventory. So that's an important note. We often get new investors and we have to warn them about that. So if you're flipping a property, make sure you know that you're not taking into payments on installment. Otherwise, you're going to get hit with all the gain in the first year. That, and also you cannot have an installment between related parties.
Mm-hmm. Somebody says, can I get a recording of this? Yes, we'll put it on the YouTube channel. Are you saying the inventory is the home? Yes, Faith. When you buy real estate to sell it, you're a dealer. Pretend that you're a car dealership and you're having cars on your lot. You have real estate on your lot. And so the IRS says it's no longer investment real estate, it's inventory, which is not depreciated. So under 453, they specifically, that's the installment sale code provision, it specifically says that when you are a dealer in real estate that you cannot use the installment sale. So this is relevant to somebody who buys, fixes up, and flips and carries back the note. You might be surprised that you're required to pay the taxes in the year that you sold, even though you're getting the money over 5 or 10 years or 20 years, right? So it's almost better to not do that if you're a flipper. That's why you don't see too many people that are in the flipping world carrying back notes, because I could flip a house, I could have $100,000 of profit I have to pay tax on, but I haven't received my $100,000. I'm going to be receiving it over the next 10 years, but I got to pay the tax this year.
Correct.
Which can be a nasty situation. Oh my God, I'm so new to real estate investing that what they just said about flipping makes absolutely no sense to me. Can they break it down for a 5-year-old? Yep. So Claire, when you buy real estate, a piece of real estate, let's say I buy a house, in my intent when I buy it is to sell it. My intent is not to rent it and hold it for the long term. My intent is to put new paint on it, new carpeting, and turn it around and sell it for $30,000 more than what I paid for. I am a business. I am not an investor. I am considered a dealer, and I am taxed as it's no different than if I had a pizza shop and I was selling pizzas. I am just a business. And that's where people make a mistake. And then you'll have gurus out there go out there and say, no, you just hold it for a year and now it's magically investment. No, the court cases on it go as far back. There's one there where it's 10-year hold that they treated the guy like a dealer. And the reason they want to is because you don't have long-term capital gains. You're treated as it's going to be active ordinary income if you're materially participating. Like if you're doing the flips and you're working in it, then you're going to have not only your ordinary tax bracket up to 37%, but you're going to get hit with the old age disability and survivors and Medicare, the Social Security taxes. That's 15.3%. So you get
a lot. Rushed on.
Somebody says, I'm still working on my diet. Easy on the pizza talk.
All right.
Pizza is diet food, just bad diet food. What happens to accumulated depreciation on a rental property when the owner passes away?
Goes away.
Yeah, you have a step up in basis. So all of your accumulated depreciation, all you have to do to never pay it back,
just die.
Is die. That's all you have to do. If somebody tells you to gift your property to your kids right before you die, ignore them. Don't do it. 9 times out of 10, you just completely hosed yourself. I see people do it still.
Or at least the kids.
Yeah, don't do it.
Yeah.
Don't do it. All right. Does the person inheriting the property need to account for depreciation recapture from the deceased owner when you later decide to sell the property?
No.
It's just a flat out no, because it steps up in basis. The depreciation is gone. You don't have to worry about it. You get to re-depreciate it. And that's going to be the next couple of questions. If the person inheriting the property gets a stepped up in basis, that's the fair market value. So mom and dad bought a property for $30,000. It's now worth $300,000. They depreciated a big part of that 30, and they die, and you inherit it. You now have a property at $300,000. You depreciated at what amount?
300,000.
Yep. You get to start doing it again. if the person inheriting the property gets the stepped up basis, does that new basis now become the basis to calculate depreciation on if you keep the property? Yes, absolutely. Can the person inheriting the rental property also have a cost seg done? And would that be affected by any cost segregations done previously?
New cost seg. And to my knowledge, the previous cost seg doesn't have any effect.
Yep.
Stepped up basis.
All you did is you accelerated your depreciation. You got, your parents got more deduction earlier. It's not like they got more deduction. They're just accelerating that deduction. Instead of taking it over 27 and a half years, you might have taken about a third of that in 1 year. Sometimes it's over stretching. So cost seg is breaking down the years from 27 and a half. Yeah, it's breaking, like, let's say I had a property that's a single family residence, same thing, and we're renting it. And normally you're depreciating everything over 27 and a half years. So pretend the carpet in that house it's going to be depreciated over 27 and a half years.
Pretty gamey.
Which is, yeah, that doesn't really happen, right? So the IRS allows us to do what's called a cost seg and break the components down, because that carpet is actually 5-year property. You're supposed to be writing it off over 5 years. So it's not like you increase the amount of your depreciation over that you would get in 27 and a half years. You're just front loading it. So you're getting a lot more deduction in the first few years than you would normally. And no, it doesn't affect it. So you can absolutely get your step up in basis, and no, it won't impact you. You'll get to write it off all over again, which is, again, that's why real estate is so obviously one of the best investments, because unlike if I bought shares in Microsoft, I can't write off my shares in Microsoft. I can't depreciate my shares in Microsoft. If I buy a piece of real estate, I get to write it off. Then when my kids inherit it, they get to write it off again at its new value. If Microsoft shares go up in value and they step up in basis, so what, right? I'm not getting to depreciate it. I'm not getting to take a deduction for my ownership. In real estate, you are. And so it's giving us a pretty big benefit. Are there any other tax considerations to be aware of when inheriting a rental property?
I don't know about the inheriting, but often the question is, do I gift? As Toby pointed out, don't gift, because you don't get that stepped up basis. Wait until the beneficiaries can inherit, that is, after someone dies.
Yep. I've seen it. I actually have a really bad story where it was the estate tax went away completely, which is a tax they impose on your estate if it's over a certain dollar amount. So back in the day, like, it was when I first started practicing, it was 600,000. Now it's 13 million. Like, it's just some really high number. I think it's 13. Is it 12 or is it 13?
12 plus, about 13 now.
Yeah, it's about 13 million per spouse. So 26 million. So you go above that, you're going to pay this estate tax, which is going to be about 40%. And there was a time when we were worried that we were going to go back down to a million. So there was clients who inherited property, and it was in the year that it would have been zero estate tax. And the dad gifted just prior a building that he had had for almost 40 years to the kids, and he gifted it. So they got his basis. So not only did now they have to pay tax on all that gain, they lose the ability to depreciate it, and they didn't get any tax benefit at all. Zero, zilch, none. All they did is cause themselves millions of dollars of extra taxes. And I hope they sent their accountant a Christmas present. It was like, what the heck? What were they thinking? Well, they thought it was gonna, that it was gonna be taxable, blah, blah, blah.
Well,
blah, blah.
and to that, Toby, we often talk about the upcoming changes potentially in the tax code. Don't just run out at all the talk you'll hear in the press and all that. We really want to wait until it's signed, sealed, and delivered before we start making decisions on your tax planning.
Yes. Don't react to something that hasn't occurred yet. I received a 1099 INT from a bankrupt crypto company I invested with called Celsius. The money on the 1099 never touched my bank account, as it is currently locked in a crypto wallet on their website for the last 6 or 8 months. It was interest from USDC coins I staked, but I left it in the wallet to reinvest. Am I supposed to pay tax on this money that I never received? Or can I leave it be and ignore it until the bankruptcy is resolved? What do you say?
They're going to tell you, you need to report it and you need to pay tax on it. And right now, that's where the IRS position is on this. There could be some unique situations, perhaps, Toby, depending on what happened with that, what got us to this point where Celsius is there.
So we've dealt with this over the years with Ponzi schemes and bankruptcies and stuff. So you have two things that occurred. You made money on your staking, and it's held in an institution that's become insolvent. And the question is, are you going to get it back? In the meantime, they're sending you the 1099 saying, here's the interest you made. And you're saying, I don't have access to it, therefore I should not be paying tax on it. And that's not the rule. The rule was you could have taken that money. You just continued to store it in a Celsius, and they ended up going insolvent. The question is whether your money was stolen or whether there was fraud. And your receiver may have opinions on that, and they may be seeking direction. The receiver is an extension of the court, and undoubtedly, if there's a bankruptcy, there's either a trustee or receiver or both. And you're probably going to want to get direction from them as to whether they believe that you're able to take a theft loss or whether it was actually stolen, and whether there was fraud. I know that I've seen these before. I can't remember Celsius specifically.
Yeah, I don't know, but you do get a letter. I've seen many of those letters where they say it's from a government institution of some sort of the courts saying that this was part of a fraud scheme, we believe. And it's kind of what kicks it off for your tax preparer to say, okay, well, maybe we can take a loss here. Now, there's specific rules to that as well, which we won't go in here. But aside from that, if there isn't any fraud, then one is required to report that interest income and has to pay tax on them, even though you don't currently have access.
Yeah, and then if you have a loss, you're typically going to have a capital loss, right? If you're going to lose your cash, or there'll be some sort of corresponding loss. The question is, in 2022, did you make money? And they say yes, and then you might have a loss in 2023, depending on what happens in the bankruptcy. Of course, you may just get all your money. So that's the thing, is they're going to say, hey, you need to pay the tax on the properly issued 1099. Your accountant could take the position that it was fraud and that you're never going to get the money back, and file your return and put a notation and see if the IRS catches it. But for the most part, you were issued a 1099 INT. It said you made this money, and now that money is in jeopardy. You still pay tax on the money that you made, even though you may not get it back. When we know for certain, it's kind of like any time you've ever had a loan out to somebody, you don't get to write it off when they don't pay it back. You actually have to show that you went through and exhausted all measures of recovery before you can actually take a loss.
Yeah, you want to be documenting.
All right. How does the tax law treat the hiring of children by an LLC? At what age can they be hired, and which circular discusses this?
All right. So the big thing people are looking for here usually is, how do I pay my child maybe in a manner that I don't have to pay employment taxes on? And that's when they're under 18, no Social Security, no Medicare taxes on those, but they must be paid by an LLC that's owned by mom and dad, if it's a disregarded LLC or a partnership, and they have to be paid as W-2 employees. So it's really critical to hit this. That's up till 18, then up to 21.
That means they have to do something.
Yes, they have to be working.
Yeah. So there's cases of kids 9 years old getting paid Screen Actors Guild's wages for being like talent on, for images and things like that, being a model for the marketing materials. You have kids that push brooms and do cleaning. You have kids that do tech, that do data entry. You just have to show what they're doing, and it has to be a reasonable amount that you're paying them. And then if it's a sole proprietor, which could be a disregarded LLC or a partnership, then you have no withholding if they're under 18, right?
If they're paid as W-2 employees, that's correct. You can't 1099 them. Now, as far as the ages, though, that's the federal government relies on the specific state. Each state has its own different rules. Most of them, the kid's not going to sue their parents, so not too many people look into that. But it is determined by the state rules.
Yeah, I don't think there's any state where if it's family members. Somebody says, do the grandkids count? I know it's with children for sure. I'm not
Yeah, I
sure.
don't know about grandkids. I don't know. that
But
they would.
here's the thing is if they're making less than 13,000 some odd, I think it's $13,850 in 2023, they don't pay tax on federal income taxes. They may still have some employment taxes if you run it through payroll, but what we're talking about is avoiding all taxes. So if you pay somebody who's 18 or under, right? Or is it under 18?
18 or under.
18.
Sorry, no, 17. So it'll be 17.
So it's under 18. So when you hit the age of majority, now we have to worry about the employment taxes, period. But the federal income tax is going to be next to nothing if you're paying these kids. Like, let's say you're $10,000 a year. They normally you have to pay their tuition, and you had to pay their tuition, and you're in the aggregate tax bracket of, you're 32%. You're going to have to make over $15,000 just for federal income tax purposes to be able to pay their tuition at $10,000. If you just pay that kid the money, even if they're over 18, like, we're not worried about the employment taxes here. I'm just saying, if you just pay them, even through payroll, it could be a C Corp, S Corp, whatever, pay them and let them pay for their tuition with the money that they earn. They may not be paying any federal income taxes. Then the employment taxes don't seem so bad. Your aggregate amount of employment taxes between an employer and an employee after deductions is about 14.1%. So you're paying a total of 14% on money, where you would be paying in some cases
37 plus.
30, yeah, because you have employment taxes too, so 40+%. So that's what you're doing, is you're saying, hey, I'm just going to be able to get much better tax treatment here if I let the kids pay for their college and things like that than me doing it. Something says if flipping is like selling pizza. Oh, somebody's going back to that. 37 and 15. Does that mean my aggregate tax amount is about 52%? It can be pretty high. It's not going to be quite there, but it's going to be pretty darn close. If you're at 37%, you've actually phased out of the old age disability and survivors portion of Social Security, which is right around 147,000. So if you're at 37%, means you're making a lot more money than that. Then you're looking at 3.8%, 2.9 plus there's an extra 0.8, so about 3.8%. So you're really looking at just over 40%. Yes, and
Could be state too.
could be state. But Claire, that's why you use an S Corp or a C Corp when you're flipping, because we want to be able to minimize that. So, and get some of that money into a 401k or get it into another business.
And as far as the circular, I didn't know what it was off the top of my head, but I do know if you just type in IRS hiring family, it'll take you right there to, they have a really nice website that goes over that.
And I'll probably do another video on that. Actually,
Yeah,
I might
it's
dive
out
in it.
there.
Yeah, we've done it before. I'll do another deep dive. All right, I am using home office and depreciating part of the house. How will it look on the taxes at the year I sell it?
It's gonna look like you're paying.
Yeah.
It's gonna look like tax liability.
So I don't like the home office. I like using administrative office in the home and having an S or a C Corp or an LLC taxed as an S or a C Corp reimbursing me for the value of my space, because then I don't have depreciation recapture. If you're a sole proprietor and you are taking a home office deduction and you have depreciation, or if you're house hacking and you're renting out part of your house, you're going to have depreciation recapture when you sell the house. Section 121 of the code allows you to avoid capital gains only, capital gains specifically up to $250,000 if you're single, up to $500,000 if you're married filing jointly, but does not cover depreciation recapture. So if you have a house and you have half the house that you're renting out, or if you've been doing a home office for years, you can do a 121 with the 1031 exchange. You can treat the part of the house that was depreciated when you sell it. You can actually 1031 it into something else if the numbers justify it. But for the most part, that's why we say don't do the home office. Don't be a sole proprietor. There's reasons not to be a sole proprietor, partially because they do get poor tax treatment and they pay self-employment tax on all their dollars, which is the Social Security taxes. It's not good, and they get audited a lot. So like there's a whole bunch of reasons not to be a sole proprietor, but 70% of the businesses still persist at being sole proprietors. Anything else on that one?
No, I think that's pretty much it.
So the answer to your question is make sure you're talking to a tax professional when you go to sell the house. You may have some recapture, but it's not the end of the world. It's at your tax rate up to 25%. So if there is some recapture, it might be annoying, but I don't think it's going to be a devastating tax, especially if you can control your income for that year. Speaking of controlling income and learning about all these different tax nuances and how it works with real estate, my partner and I, Clint, we do a real estate tax and asset protection every month, couple times a month. We have one coming up, it looks like in March 25th, and then another one on April 8th. But feel free to register. It's an all-day event. We go from about 9 to 4 Pacific Standard Time, and these are not recorded events, so we don't make the recordings available, and there's always something that's an incentive that for those who show up. But if you want to learn about LLCs, land trusts, living trusts, corporations, S Corp, C Corp, dealer status, cost segregation, accelerated depreciation, 168K, 1031, 121, all the different fund code provisions, then you want to come to this event. It's actually really fun. It's always good. You absolutely feel free. I think, yep. So Patty already posted the link. Join us. We've been doing them for a number of years, and they're always fun. So, are there any tax deductions for real estate held in a self-directed IRA?
No. When you have something in your retirement plan like that, there isn't the concept of deductions. There's just cash flow going out, paying for bills, and then there's cash flow coming in, your rent, or if you sold it. We don't have any tax consequences. So you're going to lose out on those big things like depreciation, et cetera. No tax benefit.
There is one exception, just to be annoying. And that is if you have a loan on your real estate in your self-directed IRA, then you have something called unrelated debt financed income. And that one you can use your depreciation to offset. But otherwise, you're putting it in a self-directed IRA, it's exempt, right? You're not paying any tax. You got your tax benefit either doing a traditional IRA, a 401k, rolling it into the self-directed IRA. Realistically, if you're doing real estate and you're going to be investing with a self-directed IRA, you may, and if you need debt at all, if you need any loans to buy that property, roll it into a 401k because it does not have the same rule. You do not have to pay unrelated debt financed income in a 401k. So if you're going to be buying real estate and you're going to be levering it at all, and in a retirement plan, make sure it's a 401k because it is not taxable. A self-directed IRA is taxable when you have unrelated debt finance income. So, excitement.
Yep, good stuff.
Yep, good questions. Can you explain S Corp taxes with shared distributions? When it's time to file taxes, do we pay taxes, all shared distributions, ?
So I think what we're getting at here, an S corporation has two primary ways of getting paid as an owner shareholder. One would be W-2 wages, and the other is all the other income. It comes down on a K-1, we call it. Often we'll use the term distribution, but really distribution means you took the money out. And that doesn't have to be the case. You can leave it in there and still be taxed, or you will be taxed. So your distribution share, not your W-2 income, is just taxed at your ordinary rates.
Yes, this is a big distinction. Regardless of whether you distribute the money in an S Corp, it flows down proportionately to the shareholders, and distributions have to be proportionate. I cannot distribute, like let's say Eliot and I are 50-50. He can't take money and I don't. They have to be equal distributions on an annual basis. So there's always this little game you play, especially if you have like a doctor's practice with 10 doctors in it, and and there's all these different dollars going on all over the place. You got to make sure it matches up because they have to be equal distributions. Regardless of whether you take distributions, you have to pay tax on your proportionate share of the profit, or you recognize a proportionate share of the loss. You cannot do non-pro rata distributions or loss sharing in an S Corp. And this goes for an LLC taxed as an S Corp as well. So if you have an S Corp it really doesn't matter whether you take the money out. It just matters whether there was profit. Now, saying that, I'm going to give you guys one rule that for whatever reason, nobody knows, or the accountants know, and they're like, So if you have an S Corp and you did not take distributions, you are technically not required to take a salary. And that one throws people off all the time because they say you're required to take a salary out of an S Corp. You're required to take a salary out of an S Corp if you take distributions. If you don't take distributions, if you're just growing it, then technically you don't actually have to, you don't have to take a salary. Somebody says, I was hit hard with UBIT inside my Roth where I owed $200,000 on $400,000 gain. The company is no longer in business, trying to scratch back any part of the UBIT. Is it possible happened? I don't know. Let me see.
2020.
That was 2020. Was it, Valerie, was that? I'm going to see if I can find anything else. If you got hit with unrelated business income tax, was it unrelated debt finance income, or did you get hit with UBIT where you were running an active business in it? It was a business. Ouch. And there shouldn't have been gain. It was passive. I wonder what they got hit with UBIT for.
I don't want to speak for Valerie here, but I have a feeling that they consider it passive and that you didn't do anything, but what you invested in was an operating business, and that's active. Why they hit it with?
It was leverage. Okay. So Valerie, this is unrelated debt finance income. And yes, there is something you can do. You have to take the depreciation against the, this is the only time you actually run these scenarios in a IRA. It was a Roth, so it's just a typical IRA, is when you have unrelated debt financed income and you can take the depreciation to lower the income. If they have, I don't know why they had, so they had a big chunk of the gain, so they sold it and it was levered. I don't know a way around that one. That's probably what happened, Valerie, is you had leverage and they said you owed a bunch of tax on the gain, and that must have been, that's a horrible situation because it sounds like you were taxed at,
Very high.
Yeah, it sounds like it was less than a year.
50%.
How long did they own the apartment building, or how long were you in it? Because it sounds like it was treated as short term, 10 years, long-term capital gains. So you must have been in. That doesn't make any sense, huh? I would love to see that one. California, 37%. They treated it as ordinary income, so they must have treated it as a flip. So they must have bought the apartment complex, fixed it up, and sold it. Is that what's happening? And I apologize, it wasn't a flip. Then it's not 37%. Unless they treated it as levered. Yeah, then they'd tax you at the highest amount. 10-year hold, and they taxed you on the unrelated debt financed income is what they did.
That's a lot of debt finance.
It's at the highest rate. Yeah. So you got hit with that penalty because they levered it. And I hate the fact that happened, Valerie, for you. And realistically, the promoters should be a little more careful. And if you did that through a self-directed IRA, then they should have caught it too. But we see that over and over again. It's the difference between a IRA and a 401k. A 401k would not have been subject to that same rule. I think even a Roth 401k, although it's almost impossible to get a Roth IRA into a Roth 401k. In fact, it is impossible. You can't roll it, but I'm so sorry you got hit with that. Yeah, it just stinks, but at least you made money. You got killed with taxes, but at least it was a profitable endeavor. You always see something interesting, guys. And I can see the chat. We disabled chat for everybody else just because people solicit each other. There's always a Nigerian prince or an MLMer in there that's trying to look for customers. So I'm reading the chat as we go along. So I apologize that you guys can't see that. All right, let's go back. I started an LLC C Corp with Anderson Advisors in October of 2022 for real estate investing. I paid $20,000 plus in networks, education, etc. So it sounds like you went through one of the bigger education companies. I did not do any deals in 2022 for my real estate business. Can I still write off write all that off for the business. I have used my personal credit card to make purchases for my new business. Since I do not have a business credit card, did I break the corporate veil?
So yes, you can deduct those expenses. They are going to go on your C corporation. If they were incurred prior to the date of incorporation, they'll be what we call startup costs. And you will be able to deduct up to 5,000. Anything over in the startup costs will be amortized over 15 years. I was going to say depreciated, but it's almost the same concept, but it's amortized.
Mhm.
Anything after the date of incorporation, you'll be able to deduct dollar for dollar as a dollar of deduction. And any loss you have in the C corporation will just carry forward. So the fact that you didn't have any business, don't worry about that. That's perfectly fine. And your loss will just carry forward to next year's when you do.
Here's the thing. I don't think that there's a loss in the corporation yet because it's a personal credit card. I think that the corporation will need to reimburse you first before that loss is in there.
Well, yes, as far as a personal card, to that aspect of it, you need to turn it in for reimbursement. Typically, we get it on there, and these would be the expenses that occurred after it was incorporated.
Yeah.
Generally, they go to what we call loans from shareholders.
You're going to get to write this off,
Yeah.
period. But so would you actually grab this as a deduction called a loan from shareholders? Is that what you would do?
Well, we would, yes, we would call it loans from shareholders, and we would expense the expenses, provided that, yeah, we do have to have that payback. That's right.
Because you're either doing one of two things. You're either saying, hey, I loaned you the money from the credit card to do the purchases, or you're going to loan $20,000 to the corporation to reimburse you for your expenses, at which time then it becomes deductible to the corporation, or you wait till the corporation makes $20,000 and it's just paying you back for the expenses that you incurred on its behalf. No different than if your employer did that. Like if I said to Eliot, hey, Eliot, go get pizzas for the office, and Eliot goes out and buys $1,000 worth of pizza, it's not deductible to me yet. He brings the pizzas in, everybody in the business eats the pizzas. He still owed $1,000. So what it really is I owe Eliot $1,000. I get to write it off the day that I write him a check for $1,000. So there's actually 3 or 4 ways to treat this, just to make it really confusing. But
we didn't break the corporate veil.
You did not break the corporate veil, and yes, you'll be able to write it off. You know, it's just you're a cash basis taxpayer, which means the corporation gets to write it off when it pays you for the expense. And the only question is, did it pay you for the expense because you said, I'm going to loan you my credit card and I'm going to incur the expenses and you're going to pay me back, and it gets to write it off right now? Or did I incur that expense and it's just an IOU, in which case then the corporation will pay me back once it makes money? Or do I loan it money that it can then pay me back and write it off? Isn't that fun?
Yep.
Any other scenarios you could think of?
I think that's about it.
Yeah, so that's why you guys show up, so we could just
just to that, where you run into the corporate veil scenario is if you have the corporation paying directly for your personal expenses. This is the other way around. You personally paid on behalf of the corporation. That's okay. You can do that all day long. Just don't want the corporation paying directly for your personal expenses. That's where you have that corporate veil problem.
And you're as good as silk. The fact matters, these rules are not like something implodes when you don't do something the perfect way. You get to look back quite often. You can fix things. You just document it, and you work with a tax professional, and they usually keep you on the straight and narrow. But you have always the opportunity to fix things. So yeah, it's not like you just all of a sudden it blows up and you have a piercing. No, it'd be years later before a piercing would even be relevant. All right. What somebody says, do you have any fun jokes that start something like 2 CPAs and a lawyer's walk into a bar? No, because that would be like the most boring bar in the town, like 2 CPAs and a lawyer walked in.
I do actually from law school. That happened to my student that was taught by my same tax professor, and he was in a bar. Guy walks in and starts spouting off about how he was getting around tax provisions here and there and all that. And it turned out that, this alumni of my school actually worked for the IRS as an attorney. So he just sat there, had a beer with the guy, found out more information, and, sent the audit out the next week. So that's actually a true story. That's not a joke.
A lawyer and a CPA walk into a bar and only agree on the drinks. That's about right. That's about right. All right. What org structure for small business is audited the least and provides the lowest tax liability?
That's going to be your S corporation typically.
Mm-hmm.
It's going to give you a lot of deductions and reimbursements that you can take advantage of. I don't know of any. I look at a lot of tax sources all over the web from all over the world, especially, of course, here in the US. And I don't know anybody who has hit this more often than this guy right here, as far as the statistics and tax wise and these programs and everything else in his books and all that. I'm going to turn it over to
They
him.
used to give us an actual oh, stop. How much does it cost to swim with sharks, an arm and a leg? Valerie, I do like you. So I like that one. No, but they used to have a specific table in publication 55, which is this publication. They give out all the stats every year of who got audited and what happened during those audits. Like the big thing for me is I don't care if I get audited if I never lose, right? If you knew you got audited and you have a 1 in 100 chance of losing, you probably wouldn't be scared of an audit. The issue is if I get an audit and I automatically lose like 90% plus of the time. So remember that. So when you look at these old tables, they've discontinued the last 2 years. So we're trying to piece together the data, but we have years and years and years of historical data. Sole proprietors get audited about 800% more than an S corp when you actually make money. Like when I say like right around let's just say $100,000 a year. It's about 1.4% and it's 0.2% it's 1.6% last year that they came out with stats on $100,000, and a S corp was 0.2%. So it's about 800% more often, right? So that's not good. But the worst part is the sole proprietors lose those audits between 94 and 95% of the time. The S corps lose about 69 to 71% of the time, but then again, it's like 1/8 of the audits. And if you're a sole proprietor, you pay tax, you pay self-employment tax, which is old age, disability, and survivors and Medicare. It's that extra 15.3%. There's a phase out of it, but you pay that on 100% of your net profit. So you make $100,000, you're paying the actual dollar amount is about $14,100 in employment taxes. That S corp would probably pay somewhere in their neighborhood of $5,000 or $6,000. So you're going to save $8,000 or $9,000 pretty easily just being an S corp if you're making $100,000 a year. So when I look at those, it's not even close. The actual lowest audit rate, though, of all entities is actually the partnerships, but you wouldn't run an active business out of it. That's much better. It's much better if you're going to be doing real estate out of the S corp, but they're almost never audited. And then we do over 10,000 returns a year at our firm, and less than a dozen audits last year. It's like they're so rare when you do things correctly. Usually there's a way people are getting audited. They're either putting in the wrong numbers. They're like, if it's an S corp, they're not taking a salary and they're taking distributions. In the case of a small business, they're taking crazy deductions, which make no sense, or the numbers don't add up, or the 1099s don't add up, and the IRS is not, usually the majority, I think about 70% of the audits are just correspondence audits where they send you a letter. It's just very, very, very seldom. Some people are still giving us bad jokes. An accountant was having difficulty getting to sleep at night, so she went to see her doctor. Have you tried counting sheep? Inquired the doctor. Yeah, that's the problem, yawned the accountant. When I make a mistake, I spend 6 hours trying to find it.
That's true.
That's about right. All right, enough of this nonsense. Let's get in. How do I best utilize my C Corp status for tax savings and investing in real estate? We have my 1099 paycheck going into our C Corp bank account and then pay out about half to our personal bank account as a paycheck. How do I utilize the other half that's sitting in the C Corp account, such as to buy a new short-term rental or long-term rental investment?
So one of the great things we can do here, you could take a loan out to yourself. You'd have to pay interest, reasonable amount of interest back. But you can take that loan, it gets out of the corporation. There's no tax consideration there other than the interest being earned by the C corporation. Then you go out and do your investing. Alternatively, the C corporation, before you do the loan, you can take a lot of reimbursements, accountable plan reimbursements, corporate meetings for 280A, medical reimbursements. That all gets the money out to you tax-free, deduction to your C corporation. More than likely, depending on the dollar amount, you're going to use a combination of those two. Get the reimbursements first, then the loan.
Yeah. Now, here's the one thing is they say, hey, I take my 1099 paycheck. There's no such thing. There's a paycheck, which is W-2, and there's 1099, which is you're an independent contractor. So I just, whenever I see those two words used together, just think I'm an independent contractor and my company, the C Corp is actually the one doing the service. So you got to make sure that it's being paid to the C Corp, not to you. If it is going to you, there's a workaround, but you got to make sure that if they're issuing a check, it's to the C Corp. Then you take out a W-2 paycheck, and then you have the rest of the money sitting in there. If you just leave it sitting in the corp and you don't do anything, it's going to be taxed at 21%. And, if you wanted to pay that out to yourself, it's going to be long-term capital gains to you, depending on how much money you make. If you're married filing jointly and you make less than $88,000 a year, it's zero, right? So you just, but usually in this scenario, when we see this type, I'm probably putting a 401k or something in place, and you're going to put money into a retirement plan. So if you have half the money that you're living on and the other half, well, let's get more into your 401k. We can contribute 25% of your paycheck, plus you could, what is it, about 20, oh yeah, I forget the amount this year. It's like 22.5, I think is the amount that I could defer directly in. So I could do, let's say you're taking $50,000 in payroll, I could defer immediately 22,500, actually 30 if you're over 50. So you could put a big chunk in there, plus your company can contribute 25% of what you got paid. So if it's 50, then they could pay another 12,500. And now you just managed to put a whole bunch of money tax-free, over 40,000 bucks. That number to me adds up to 42,500 right into your retirement plan. Out of the 100 grand. So like you're going to pay zero tax on it. That's how you do it. So if you're making money through your business, if you don't have other employees, then it can be really beneficial. Somebody says, wow, that gets complex. It's numbers. It's just sitting there giving yourself the options, A, B, C. Eliot here and all the tax analysts, that's what they're doing. They're always kind of going through saying, here's your choices. You can do A, B, C, D, and which one's going to get you the best result for the amount that you're working. And it's not that big of a deal. Once you get through 1 year of doing a 401k, they're not really that complicated. They're actually pretty straightforward. There's not a lot of paperwork. And but why would you want a 401k? Because you don't have to pay tax when you put the money into it. And you can grow your strat. Like if you did long-term rentals in that or short-term rentals in that, you wouldn't be paying any tax on it. You could also borrow from a 401k. I like 401ks. And then you can use that 401k money to buy other investments. Correct. Yep. You don't have to worry about tax on those investments. So if you do stocks, you could do covered calls, you could do the wheel strategy we teach in infinity investing, and you could just be making money constantly, and it's not taxed until you take it out. There's so much stuff we could do. Like, again, it is somewhat complicated, but that's why you work with somebody who can give you the scenarios. Because for us, it's, hey, A, B, C, D, hey, look, C is obvious, right? Or B is obvious, but you could always play around with it. And then Patty's pointing out, you could always go to my YouTube channel. There's, hey, there it is. There's a ton of different strategies sitting on there. In Faith, it's a process. So I always tell people it's about 1.5 years of getting used to the vernacular and talking kind of tax. And all of a sudden it just starts to go click, click, click. Once you do it for yourself and you see tax savings, it becomes relevant, and then it becomes more interesting. If it's, not, if it's something you just want to hand off to somebody else, you can certainly do that. But you really should know some of the basics. We do a TaxWise workshop. These guys do it about every other week now.
Yeah, every 2 weeks.
Every 2 weeks, where they're going through the strategies and break it into bite-sized pieces. So we have tons of content where we will teach you how to do this stuff. And then once you do it a few times, it just becomes second nature, and you think it's not really that. It's like compound education. There you go. What I care about is just the benefit. once I start seeing benefits, then it becomes important and relevant to me. But think of it like this. If somebody walked up to you and said, I'll pay you $1,000 an hour to learn something, that's about the return that tax education is. That what they don't tell you is it'll end up being $1,000 an hour every year for year after year after year. And it really starts to add up when it comes to retirement. It's the difference between having $10,000 in your account and having $1 million in your account over a long enough time horizon. So that's all it is. There's YouTube. It's free. You go in there. Always have fun stuff that I'm posting. And we have a really good group. And last but not least, if you have questions, I see a ton of questions. They've answered, by the way, I got to just shout out to my team. Let me just tell you guys how many folks are on answering your questions right now. We've answered over 200 complicated questions. Troy, Tanya, Sergey, Ross, Kurt, Kenny, Jared, Dutch, Dana, Patty, and Matthew are all on. And it's not like we're paying them. Okay, we're paying them, but it's not like you guys are having to pay them, right? They're answering your questions and trying to do the best that they can to give you some clarity. And we know it's complicated out there. Like they passed how many tax acts in the last, 3 or 4 years? They keep changing. They keep moving the goalposts. They change stuff on a continuous basis up until, it's nonstop because they're always doing regs and they're always giving additional guidance, and they contradict themselves, and a court case comes out that poops right on everything, so like you're always trying to do the best you can. And we're just trying to make sure that people are going in with their eyes open so that they're able to take so they're able to take things into account when they're deciding what to do, so that they can do things in the way that's best for you, as opposed to just giving it over to the government. We happen to believe that money is better off spent at home in your hands than it is giving it to a government. As much as we love the government, but we think that you're a better steward of your money than any governing agency or any governing body. And the tax code is written for your benefit, so we may as well utilize it. They just make it a little bit complicated. So I'm just telling you, we got a lot of folks out there to help you. Even right now, they're all just churning away, trying to answer all your questions. What we're going to do now is say thank you for joining us. Send in your questions at taxtuesday@andersonadvisors.com. You may see it posted on here. We may be answering it live. If nothing else, we'll make sure that we get a response to you. Anything you want to add?
Thank you so much for joining, and look forward to seeing you again.
All right. What I'll do is you're going to see us go mute. But for those of you who have unanswered questions in the Q&A, hang on. They will answer them all before we are done. But thank you, guys. Make sure that you come to the tax and asset protection events that we hold. Clint is amazing speaker, so they'll get there. And then as far as tax-wise, I think it's in the tax toolbox. So go to the tax and AP event, learn about the business essentials package, or ask your rep about the tax toolbox. You guys may have access to it. You may not even realize it. And it'll be sitting in there, and you'll be able to continue to do all sorts of fun stuff. So we'll make sure that we're helping you out. So by all means, join us for those workshops and just plug in. You don't have to become a client till you're a good, set, and ready, but you can absolutely learn together with us, and we'll always be giving you relevant information that hopefully puts more money in your pockets. So we will see you next time, 2 weeks.